Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:30 a.m. Central Time, and I'm recording this in preparation for the market day of December the 21st, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And we did have quite a bit of action last night. The broad market futures are all up, and the S&P are up about 20 points at the time of this cut, or right at 1%. Russell futures are up about 0.8%, NASDAQ up right at 1%, and Dow futures are up about 0.9%. Crude oil down about 1%. Euro essentially scratch. Bonds are about scratch, and gold is up about 0.62%. In overseas action, you have China up about 1.7%. Hong Kong up just marginally. Japan down about 1/3%. Germany up strong also about 1.35%. United Kingdom up right under 1%. In terms of macroeconomic reports for this week, start the week out pretty light. There's nothing on the U.S. schedule for today. For tomorrow, you have final GDP and existing home sales. That's about it. And then looking forward to Wednesday. We'll have a number of reports on Wednesday, and that'll be the primary action for the week. And actually quite a bit on Wednesday. Thursday, of course, will be a half day in the markets. Many traders will be absent. And in fact, many traders will be absent all week. Volume will likely be very, very shallow volume, not a lot of follow through on signals and so forth. So be very, very careful if you trade intraday during this week at all. In terms of Thursday and Friday, I would not expect any action on Thursday to speak of. And then Friday, of course, the markets will be closed. In terms of current volatility conditions, short-term VIX is down below a 20, 19.38. Skew still elevated, but not as high as it's been. IV percentiles, S&P 31, 26 on the Russell, NASDAQ 28, and Dow 37. We had quite a bit of action on Friday with a 3 standard deviation move put in on the Dow, 2 standard deviation moves put in on the S&P and on the NASDAQ. Note on the S&P we've had 2 standard deviation moves 3 times in the last 6 trading sessions. So there's really been quite a bit of volatility this last week or so. And some of this has been two-sided action, but obviously, and we'll go to the charts right now, some of this has been pretty weak. Let's look at the S&P first. And while we expected something of a pullback, this has been much weaker the last 2 trading sessions than I think many people probably would have liked to see. And we've just about come back to this former swing low. And you remember that was a critical swing low where the bulls really had to take off that point, or it was in danger of having significantly greater weakness, as there wasn't a lot of support in the next 100 points. So right now it would look like we're going to open well up, and perhaps even about halfway through this Friday down candle. So we'll see where that goes. But bottom line is that Thursday and Friday was not a good thing for the bulls at all. And you see about right now we're down off the highs of the overnight session, but we're still well up. And certainly it would seem that we're not going to be visiting these lows today unless there's a big reversal. In terms of the Dow, see Thursday, Friday action also very ugly here. And in the case of the Dow, it actually broke through this prior swing low. Not by a lot, but it closed, not just broke it, but closed below that swing low. So very important that the bulls and the Dow picked this up today. NASDAQ, very much like the S&P, and then of course the Russell, which has been decidedly weaker than the other indices. Right now, I'd have to say that the Dow is the relative weak in terms of where it is relative to this last swing low. Volatility futures, we've had something of a pop up here, up over 20, though with tonight's action, certainly this is down below a 20 at this point. But until it gets down to below about an 18, it kind of confirms down there. We're not going to put too much into this. Bonds have been climbing with this market weakness. A lot of people thought that bonds would get crushed with the advent of the Fed raising interest rates, but the long bond, of course, is not anywhere near as impacted as what the Fed is doing to short-term rates. This has got other factors that kind of drive it primarily. And one of the things, of course, is the safe haven status. When the market truly gets fearful, the long bond is going to be the place to go, more so than gold, it would seem, of late. And this is also the place to go, not just for U.S. investors, but global investors. They go to our long treasury bond when they need a safe place to park money. So kind of keep that in mind. And if we continue to see weakness in the U.S. equities, we'll likely see that this will continue to inch up. And you notice all the way back here into November, this really is kind of climbing up back towards these former highs, which would on this current contract would be up around 159 and change. Okay, so enough on that. Let's go to the daily report. We're still at phase 2 trend reversal. Well, the expectation is that the swing low will hold, but if that breaks, then that would be certainly a break of diagonal and horizontal support. Uptrend under pressure is the IBD status. This confirmed uptrend that we had most recently, which was the 11th signal for 2015, lasted all of about 2 trading sessions before its status came into question, and we continue to see a lot of weakness. Accumulation distribution score for the S&P is a D-, NASDAQ a D, GMI index only a 1 out of 6 with a sell signal since 1210. That author continues to remain largely in cash. Decision point scoreboards, you see the short term very, very weak signals. Nothing there for the bulls whatsoever. Intermediate term still holding up, but that is really, when you put all this together, we're in a transition phase, and there's nothing really for the bulls or the bears to get overly excited about until we break out of one side or another of this transition phase and get these time frames all stacked. Right now, we're very much in transition, and you really can't make much more of it than that. In terms of the intermediate term market posture, it is currently signaling bullish. This has been flipping back and forth, so be aware of that. Technically, the S&P is in a bullish stance at a 35.9. Dow's in a bearish. NASDAQ's bullish, and Russell has also turned bullish. Again, with this mixed time frames, we'll see these signals flip back and forth, and I wouldn't make too much of anything until we break out of one side or another and confirm that breakout. In terms of position sizing opinions, you currently have 50% on the portfolio position sizing opinion. On the volatility base, that's also at 50%. Hedge warning status, we've got at level 2. Equity risk short term of 4 out of 10. Short stocks on the intermediate term a 5 out of 10. In terms of those individual warnings, we still have quite a few. Market and decline, sharp increase warning are present. VIX futures up over 18. The distribution day count just restarted, and yet already at a 1 on both the S&P and the NASDAQ. VIX phase has been increasing. Skew remains to be elevated. You have also the new high, new lows in the New York Stock Exchange on Friday, 603 new lows against only 87 new highs. All 5 key intermarket risk aversion indicators are currently flagging as risk off. And you see the fear and greed index is is certainly showing a risky area. In terms of the special opinions, option income strategies, the VIX is outside the acceptable window, so not acceptable to initiate new positions for novice traders. Same thing with the covered calls and put sellings. Conditions not acceptable to initiate new positions for novice traders. More aggressive traders may take advantage of these elevated premiums that are available now. You just got to know that you're going to be dealing with higher levels of delta and vega moves. Adjustments may be more necessary. Certainly, if you construct your trades right from the get-go with more defensive structures, such as using a mix of in the money and out of the money strikes in your covered calls, a mix of high beta, low beta, perhaps maybe even using more low beta than high beta at this point. Also, in terms of put selling, make sure that you're in a defined risk position. Go ahead and spread those things off instead of using naked. Also, use a position size and a scale that you're willing to own. So that's for the more aggressive traders. In terms of sector-specific information, it's pretty much a sea of red, and you can see why you would need to be very defensive if you were to initiate a new position at this point. This is not the kind of conditions in which you have high probability setups. It's really truly more speculative in nature. In terms of percent change, you see everything down on Friday, even utilities. We've talked about utilities of late and how they're more defensive. Well, yes, they are, and they held up better than everything else, but they still lost over 1%, and that is not the land of making money. So financials, of course, down over 2.5%, so you see the range in between. In terms of the relative rotation graph, I thought this was also kind of interesting for this weekend. You see, you want things up here in this upper right box. Well, the only thing that's up there right now is the Dow, and it's tailing down. And you have the NASDAQ, which has kind of worked its way up into that upper right box. But that's kind of it. I mean, all the other either sectors or indexes or industry groups and so forth are all, basically moving into the bottom left box, and that is not the place to be. So this is just another signal that things are not in great shape. So I think that's probably enough for today. This whole week will likely be very light activity by the market and myself. Very little going on in terms of initiation of any kind of new trades during a week like this typically. So some special opportunities here. One I'll just mention today, this covered call mastery course. I expect to start rolling out the specific details on this next week. But if you are interested, I think you might be interested in getting more details about this, just send me an email to Stephen@FalconGlobalTraders.com. This will be a very comprehensive course, and will be available both for those that are able to attend live in person in the western Chicago suburbs, or in simulcast or virtual attendees. We will be recording and broadcasting at the same time, so that may also open this up for those of you who are a long way from Chicago. But cover call mastery course now taking names. As always, if you find what you're getting from here is helpful to your trading, subscribe to us on the YouTube channel. That'll give you an update, email notification when new content is posted. Also, you can like us there. That's how we get acknowledged for the work that we're doing. This is free content to you, so if it's of value to you, you can demonstrate that value by retweeting us to your Twitter followers, to your StockTwit followers, liking us on YouTube, and the like. Comments can be sent to support@FalconGlobalTraders.com. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers, and also notice the hyperlink down here at the bottom that takes you to the full disclaimers. And we'll see you back here tomorrow morning before the market opens with the Falcon Global Market Preview. Good trading.